Okay, good day everyone. This is DBS Group Holdings second quarter 2024 financial results dated 7 August 2024. Date of recording of this video is 23rd December 2024. Alright, we look at second quarter results. Net profit is up 4% year on year as total income has risen by 9%. If we look at the commercial book, total income is up 9%, right, due to higher net interest income, right, fee income, and this at a record level now, and increase in treasury customer sales. Right, so second quarter is up 9% for all these three parts, right, but it's a good result, but as opposed to the first quarter, which is up 14%, right, the second quarter is a less good result. Market trading income is up 6%, expenses are up 12%, with Citi Taiwan accounting for 5 percentage points. Right, if we look at quarter-on-quarter results, comparing first quarter and second quarter results, generally net profit is down 5% quarter-on-quarter. Right, the only positive for second quarter versus first quarter is commercial book net interest income rose 3% because of a 6 basis points NIM expansion. Right, so this is the only positive. Although fee income has reached a new all-time high, it's actually only $5 million higher than first quarter, which is not even 1%. Right, so the rest are negative. Right, this part is down 23%, down 24%, expenses is up 4%. Okay, first half generally very good results because of mostly from the first quarter, but second quarter result is also quite good. Right, total income is up to a record level. Profit before allowance and net profit are all at record numbers. If we look at second quarter commercial book, net interest income is up 3% quarter on quarter as NIM rises 6 basis points to 2.83%, right? So previously it was 2.77, now it's 2.83, right? Group NIM, however, is flat at 2.14. Okay, loans are stable quarter on quarter, up 5% over the first half in constant currency terms. Okay, deposits are stable quarter on quarter. Surplus deposits are profitably deployed into high quality liquid assets, right, boosting liquidity ratios. Second quarter fee income has risen year on year due to wealth management, cards and loan related fees. First half results are at a record high. Right, so you can see this is a record high first half results, and if you look at the quarter on quarter performance, it's quite clear that a lot of it is due to wealth management. If you look at the 2023 quarter on quarter results, even with the first quarter 2023 results, you'll see that wealth management has never surpassed $400 million per quarter. Alright, in 2023. However, in 2024, it has so far been consistently above $500 million per quarter. So you can see that it's a much bigger part of the pie for fee income nowadays for DBS. Okay, first half commercial book non-interest income is up 24% year on year from record fee income and treasury customer sales. Right, although you can see that I think the second quarter result is slightly below the first quarter result, but it's still higher than last year's results. First half cost to income ratio is at 39%. This is roughly where I think they expect to be. Alright, and you can see second quarter is 40%, first quarter is actually 37%, right? So it went up in second quarter. Okay, first half consumer banking and wealth management income is up 18%. AUM for wealth management is up 24% to a record $396 billion. Right, institutional banking income is stable. First half treasury customer income is up 26% to a record. Right, so in summary, they have delivered a strong quarter, bringing first half earnings to a new high with ROE at 18.8%. Right, this is higher than their target of 15 to 17%. Okay, however, I do believe that they expect this number to trend towards 15 to 17%. Alright, we'll go to the media transcript. Right, so anyway, this is Gupta who says that group NIM was more or less flat. Right, we did not report any loan growth, but in reality they have new loans right, as can be seen from our loan fees of 180 million. However, they lost some loans for other reasons because some clients sold large asset portfolios and repaid us. Right, so could be high interest rate environment, they decided holding on to assets were risky and therefore they sold the assets and pay off their loans. Right, so wealth management rose 37%. If you exclude Citi Taiwan, that means organically it's still 26%. Okay, first half the growth was 30%, excluding Citi, Taiwan, and we continue to see new money inflows, and the percentage of AUM in investments went up by another percentage point to 55%. Cards were also relatively strong, up 9% excluding Citi. Therefore, fee income was strong across the board. Cost to income ratio more or less steady. They do not see signs of stress in general for asset quality. Real estate portfolios in China and Hong Kong continue to be stressed or a little bit stressed, right? But the assets are mostly secured and they do not have large vulnerable exposures, right? Okay, so we are happy to hear that. Consumer side card delinquencies picked up in first quarter, leveled off in the second. Right, non-card unsecured lending delinquencies were creeping up in some markets, Hong Kong and India in particular, but the exposures are not material, so shouldn't be that big of a deal for DBS. So overall asset quality continues to be quite good at this point. Right, so they say they have resiliency against potential economic slowdown and low interest rates. They have general allowance of $4 billion, with more than half of it in management overlays that are above what models require. The overlays have been in place since COVID and they have not touched them. So we have reasonable amount of dry powder to absorb any unexpected risk from recession. Right, so it's good to hear that they are conservative. Right, for interest rate risk, they have built duration. Past few years, they have added 60 billion of fixed rate assets, bringing total to 190 billion. So we guided at one stage that our interest rate sensitivity was 18 million to 20 million per basis points of Fed fund rate. That's why when rates climb, our bottom line went from 6 billion to 10 billion dollars. So they are making more money, right? So what we've done over the years, prepare for a new environment. A lot of our CASA balances have gone into fixed deposits and they are therefore less sensitive to rates. So what they did is they try to tie their CASA down to fixed deposits so that when interest rates vary, they won't be affected as much. So yeah, this is also something that points towards the bank is more on the conservative side, because instead of making more money from the fact that the CASA is of lower interest rate, so they have to pay lower rates to borrow people's money, right? They rather give them a bit more in fixed deposits and then lock in the rates for a longer term, right? So as a result, the book is a lot more resilient to both credit and income challenges, right? So however, they say it's hard to say how market volatility plays out. If markets sell off massively, there will be some impact on wealth management. Good news is after the sell off the day before, right, I think they were talking about the around the 7th August area. Okay, markets rebounded strongly yesterday, and we have not seen any latter momentum with July numbers strong. Okay, we expect total income growth to be high single digit for the year, which is stronger than we previously gave in terms of expectations. I think allowance can also be better than previous guidance. Yeah, I don't think these things will cover too much. Right, so here they talk about areas of concern with real estate in Hong Kong. So they say the total commercial property exposure in China is 14 billion, 5 to 6 billion to state-owned enterprise, which are pretty solid. So this one most likely no issue lah. The country can print money to pay off this, I guess, right? 5 billion to foreign enterprise such as Singapore companies, which generally I think are reliable lah. But this one is a higher risk area as compared to state-owned enterprise, and 2 billion to private enterprise and REITs lah. So I guess about 7 billion is a bit more risky side, right? So total exposure to Hong Kong is 30 billion, of which commercial real estate is 18 billion, which includes 1 billion to Chinese companies in Hong Kong. The bulk is to established developers, but there's a small amount to companies that are not blue chip. Because of headwinds in the property sector, there have been some migration in asset quality categories to our portfolio from amber to red. Right, numbers are not big, but as the portfolio migrates, we add general allowances. Right, so we have 2 non-performing loans in the portfolio between China and Hong Kong this year of about 100 million each in the first and second quarter. We expect one of the cases to get resolved soon and will get repaid. Right, so I think the other one is probably going to be written off lah. Right, so they say that at this point in August they assume 8 rate cuts over I think 2025. Alright, that's what he means, I think. right? If rates comes down, loan growth will go up. So I think this is always the mitigating factor for the bank. Even though interest rates come down, they will make less money from each loan they make, but because more people borrow money, so it may compensate somewhat. Okay, wealth management should be fine unless there's a big sell-off in the market. So wealth management seems to be quite tied to market performance. Right, finally they talk about digital banks. Is there a threat? Right, so generally he says they're not really a threat because they generally use pricing to attract customers, and they can only do so for short periods of time because they will lose money in a price war, right? So they generally will only compete in niche market segments, right? So for DBS, they say they are getting CASA growth everywhere, including Indonesia and India. So they combine digital and physical branches. So if you look at the annual report, they say the digital side of the business is a lot more profitable than the physical side of the business, right? So however, you need to have physical branches because customers still like to see branches and then transact on mobile and desktop, right? So he says you need to be digital, right? That means both physical and digital, and not purely digital, right? And I think this is very true. If you want to put a lot of money in the bank, right, you rather they have a physical location rather than just be purely online. Because if let's say your app doesn't work or the internet banking don't work, at least you can go down to the branch and talk to a human being and say that, hey, what's happening to my money, right? You don't want to put everything in digital bank, and then for example if it shuts down and then there's nowhere you can go to look for a human being to talk to regarding your issues, right? So yeah, they say they try attracting customers through digital marketing, but I think they got eyeballs but not monetizable, so it's not a profitable venture, right? So yeah, so they're saying digital banking is not really a threat to them, right? So anyway, they say they have some things that they only have for mobile, for example in India, because I think India the penetration for handphones is a lot more than desktops, right? But they decided that, they realized that they should also have the desktop version, right? Yeah, I think they also announced at this point that Shu Shan will be taking over as CEO, right? So yeah, the analyst transcript, right? So here he's just talking about investment banking. Why is it so weak, right? He says that investment banking is basically not a good business in Asia, right? The amount of money they make is very small, even in the best of times, right? So Hong Kong, yeah, so because interest rates has already started to drop in this period, right? So they say that they hope that this will help the developers stay afloat, right? Because their inability to service loan is due to high interest rates, right? Their loan to value ratios are conservative, and so they can stomach a 30 to 50% drop in property value without having to take significant write-offs, right? So that means to say, even if they let's say the asset is worth $100, they only allow them to borrow maybe $50. So if the asset goes to half price, they still should be able to recover their costs, right? So this one I don't think I'll go through. Yeah, so this one we talked about it earlier. Basically, they gave up some earnings, right? So rather than to have very good profits, maybe the last 2 quarters, right, they actually gave up some earnings by locking customers into fixed rates, right? So what it does is that when interest rates go down, right, they will actually be less sensitive to the drop in interest rates. Yeah, so that means to say the earnings will be more flattish. Yeah, so I think it's this part, sorry. The shift from CASA to FD has lower interest rate sensitivity, right? So when the liabilities are in CASA, the impact of the rate movement accrues to the bank, but the massive conversion to FD in recent years has reduced the sensitivity. Therefore, if rates go down, the NIM compression is less, but in the longer term, I think money will flow back from FD to CASA, and our interest sensitivity will go back up. Right, so anyway, last part, yeah, it's an elevated payout ratio for next 3 to 5 years possible in theory, and what's the board's thinking, right? So again, this is the second time they have said this not only possible in theory but also in practice. They have too much capital even before factoring the Basel transition, right? But he said that is Shu Shan's first day, so they will talk about it later on, right? And you will see that in the next part, they will announce a buyback in 3rd quarter, right? So Yeah, so anyway, I think I won't discuss this. So they were just talking about how the wealth management in Singapore is faring. Also within Asia, right, they say that Singapore is getting a disproportionate amount of money flows. Of the 1,000 family office that open in Singapore, right, we have 50% market share. So I think DBS is doing well in attracting the wealth side for Singapore, right? So I think with that will be the end of the this second quarter update, right? Remember, no financial advice is given in this presentation. Thank you for listening.